$200. That is not a meme. That is not hopium. That is not a Reddit thread fever dream from 2021. That is the number sitting inside institutional research models that will never make it to your brokerage newsletter. And the reason you have never seen it on CNBC, Bloomberg, or any platform that sells advertising space to the same banks holding concentrated short positions is precisely because the number works. Meanwhile, every analyst who told you $67 was the bottom, every talking head who called the pullback from 100 the obvious top, every institution that downgraded silver miners while physical inventories collapsed beneath their feet. They just got fired, not by their employers, by the market itself. This is money untold, and what you are about to hear is not a prediction dressed as analysis. It is the structural math, the vault data, the positioning asymmetry, and the supply-demand physics that make $200 not just possible but statistically inevitable inside a specific set of conditions that are already unfolding. If you want these transmissions before the mainstream catches up, subscribing costs you nothing except the illusion that financial media tells you the whole truth. Now sit with that number, 200. Because everything that follows was built to show you why the people paid to be wrong are terrified of it. Let us start with the crime scene. Silver breached $100 in January 2026, according to the Silver Institute's February 10th press release, the first triple-digit print in the metal's modern trading history, a psychological barrier that took decades to approach and seconds to shatter. Then came the correction. Spot pulled back below 80. The financial press exhaled. Analysts who had missed the entire run from 22 to 100 suddenly found their voices. Overbought. Parabolic exhaustion. Obvious top formation. The calls clustered around $67 as the new floor. Some desks published it, others leaked it to financial media proxies who repeated it without attribution. The number became consensus precisely because consensus is how institutions create liquidity to exit positions they no longer want at prices they still control. CNBC's silver spot page for XAG showed 71.29 at 1:34 p.m. EDT during one session. The daily move printed negative 5.3976%. And every retail participant who watches price without context saw confirmation of the top thesis. But price without structure is a lie you pay for later. Because while the screen bled red, the vault system beneath it was hemorrhaging metal in a direction that made the 67 floor call not just wrong, mathematically indefensible. COMEX registered silver inventory dropped below 100 million ounces according to official depository statistics dated February 11, 2026. The specific figure reported was 98,138,005 ounces after a single-day adjustment of negative 3,256,882 ounces. Read that again. 3.2 million ounces vanished from the deliverable category in 24 hours. The eligible category reportedly lost another 4.7 million in the same window. This is not a rounding error. This is a vault system printing withdrawal rates that do not match a market cooling off. This is physical metal leaving the delivery pipeline while analysts told you the trade was over. The London Bullion Market Association Vault data page states that as of end February 2026, there were 27,065 tons of silver held in London vaults. LBMA describes this as a 2.4% decrease from the previous month. The conversion reads approximately 870 million ounces, down 2.4%, in a single month, while paper said, collapse. Now tell me the 67 bottom thesis was built on anything other than hope and positioning. The Silver Institute's press release explicitly states the market is expected to remain in deficit for a sixth consecutive year in 2026. Sixth consecutive year. The projected shortfall is 67 million ounces. Total global supply is forecast at 1.05 billion ounces. Total demand exceeds that figure, and the Institute explicitly states the market will continue to rely on the release of bullion from above-ground inventories to bridge the gap. This is not a cyclical imbalance. This is a structural drain. Every year the deficit persists, the cushion gets thinner, every inventory drawdown accelerates the timeline to a market that simply cannot clear at current prices. Physical investment demand is forecast to surge 20% to 227 million ounces. That is not speculative fever. That is measured institutional-grade accumulation happening while the mainstream narrative says the rally is exhausted. When supply is flat and demand is climbing and inventories are falling and the market has been in deficit for 6 straight years, the math does not care what an analyst's price target says. The math resolves in one direction, up, violently. The Commodity Futures Trading Commission's Commitments of Traders report updated March 2026 shows non-commercial longs at 33,306 contracts, non-commercial shorts at 8,128, net long position of 24,578 contracts. The speculative category is not positioned for a crash. They are positioned for continuation. When large speculators hold a net long of nearly 25,000 contracts, while spot prints red days that shake out retail, you are watching two different markets, the one they show you and the one they trade. The divergence between price action and positioning is where violent moves originate, not because everyone is right, because enough participants act on the same structural thesis simultaneously that the market reprices faster than the opposing side can exit. The 67 callers are not just wrong on price, they are wrong on flow. And before anyone dismisses structural skepticism as conspiracy, remember the receipts already exist. CFTC press release 826020 documents that JP Morgan Chase and subsidiaries settled charges for manipulative and deceptive conduct spanning at least 8 years. The total payment was $232,69. The Department of Justice's Deferred Prosecution Agreement confirms the conduct included unlawful trading in precious metals, futures explicitly naming silver. The enforcement record is closed. The behavior was proven. The fine was paid. Now it is 2026. The vaults are tightening. The positioning is tilted. The divergences are stacking. You cannot assert the same conduct is occurring without evidence, but you also cannot pretend the market's psychological foundation is intact. Once manipulation is proven at scale, every anomaly carries a question that did not exist before. The question behind $200 is not, could it happen? The question is, what would stop it? And the bearish answers are getting thinner by the month. Because if your thesis cannot survive the opposing argument, it was never a thesis. It was a wish. Here's what the bears hold. Total global supply is rising 1.5%. Recycling is projected to surge 7%, breaking 200 million ounces for the first time since 2012. Industrial fabrication is expected to decline 2% as photovoltaic manufacturers substitute away from silver, even as solar installations increase. Jewelry demand is dropping 9%. Silverware is contracting 17%. The SLV short interest stands at 37,149,254 shares, representing 6.75% of float as of February 27, 2026. A disciplined bear reads this and says, supply up, demand categories down, substitution accelerating, recycling unlocking, volatility destroying late longs, 200 is a fantasy. That argument is not stupid. It is built from the same data set. And if you cannot hold it in your mind while holding the bullish thesis, you are not analyzing. You are cheerleading. But here is what the bear case misses. Physical investment demand is surging 20%. That single category is absorbing the softness in jewelry and silverware and then some. The deficit is not closing. It is persisting. For 6 years running, inventories are not stable. They are falling. London down 2.4% monthly. COMEX registered below 100 million and dropping. And most critically, the bear case assumes orderly markets. It assumes the paper price and the physical price remain linked. It assumes delivery obligations can be met. It assumes no sovereign buyer steps in with size that the current inventory structure cannot absorb. Shanghai silver premiums have reportedly traded 10 to 15% above Western spot. India absorbed 40 million ounces into ETFs in a 2-month span, according to market commentary. The Shanghai Futures Exchange implemented stricter hedging quotas requiring physical business ties. The East is buying, the West is paper trading, and the vault system sits in the middle, shrinking. When the registered category crosses a threshold the system cannot defend, repricing is not gradual. It is discontinuous. The shorts who called 67 do not get to exit at 68. They get to exit at 120 or 150, or they get carried out. The case for $200 is not about enthusiasm. It is about the exhaustion of the alternative. If the deficit persists, inventories must fall. If inventories fall below deliverable thresholds, futures lose credibility. If futures lose credibility, price discovery shifts to physical markets. If physical markets are tighter than paper markets, the arbitrage resolves upward until enough metal is shaken loose to restore balance. $200 is not a target. It is the price level at which enough holders sell that the market clears. Below that level, the data says holders are not selling. They are accumulating, and the inventory data confirms more metal is leaving vaults than entering them. You can call 67 the bottom. The vaults are calling you a liar. If silver can trade at 30 for years while the market runs deficits, who was supplying the metal? If silver can spike to 100 and correct while withdrawals accelerate, Who is absorbing physical at prices the paper market says are too high? If registered inventory is below 100 million ounces and falling, how many delivery cycles until the system cannot perform? These are not rhetorical questions. They are engineering constraints. And engineering constraints do not care about analyst calls. The 67 bottom call was not analysis, it was inventory management, a narrative deployed to create the exit liquidity institutions needed while physical metal moved in the opposite direction. The 200 case is not hype. It is the structural consequence of 6 years of deficits, collapsing inventories, surging physical demand, and a paper market that has already been proven manipulable. If this gave you a lens you did not have before, send it to someone still reading price targets from desks that missed the entire move. Drop the words "Money Untold 200" in the comments so I know you made it through the math, not just the headline, and stay locked to this channel. Because when these numbers update, you want to be reading them before the revision, not after. This is Money Untold, the story they do not publish, the math they cannot hide. Stay curious, stay skeptical, and always follow the metal.